I know you can't answer me back, so a lot of the questions I ask you will be for flavor and rhetorical quality, if you don't mind. Um, as Nikki said, my name's Greg, Greg Andrews to be exact, and I probably know at least a handful of you, if not a lot more. I've given a lot of talks at the association over the last 2 to 3 years. Financial literacy classes. Why financial literacy? Because I'm a financial advisor by trade, and I run my own boutique advisory shop, and I advise people on personal financial planning, and anywhere from just getting started. Obviously, there's not a lot to advise on at that point. It's more of educating, and then all the way up until my specialty, which is retirement planning, getting people ready and making sure that their retirement plans are going to hold water. And the last 9 years, that really hasn't meant a lot because, well, we've had a bull market, and bull markets are pretty fun. And it seems like everything you do works, and every stock you buy works, and every mutual fund you buy is up. That's just not the behavior that we all want to get into, thinking that we will never see darker days, and now we see them. Little did we know it would be due to a virus that got onto our shores so quickly and so mysteriously. My job today, and always has been with these financial literacy classes, is to make you guys more intelligent, successful, long-term, and I stress long-term investors. We're not day traders. I don't, talk about that kind of stuff. It's, to me, that's just not even worth talking about. I'm not a speculator. We talk about long-term fundamental investing. With some of you, I hope I've succeeded over the years. I know I have some clients that have come out of your association, and I imagine there might even be one or two on the phone call. But for the rest of you, I'm going to try to help you get there through these discussions and small educational flavorings I'm going to throw your way. Okay, so I'm going to share my screen with you once we get to some more of the visual stuff. And that will be for those of you that sort of want to take this to the next level, because I can give you things to make you feel better about the way things are going, or I can give you a couple small factoids and numbers, but I think that the graphs will help you get that 102 type education, and something you can also look at yourself when you want to Google economic statistics that are relevant to our situation right now. Along the way, Nikki's going to give you prompts for Q&A. You may be able to submit questions if they're really, really good. Nikki's going to pick some out, and we'll push the Q&A till the back end of this talk. Let's get started. As I said, I'm really glad to have you guys all tuning in today, mostly because I live alone, and over the last few weeks, I've started to talk to my furniture. And by that, I mean more than normal. I've been talking to my furniture a little bit more than normal. I don't have a dog. I don't have a cat. So my furniture, I guess, it absorbs a lot of my shaming. When I do go to the grocery store, believe it or not, I try to buy as little as possible. Not because I'm a nice guy and wanting to make sure everybody gets their fair share of toilet paper, but because I want to see people's faces. And, of course, then I return home and I watch some really good quality TV programming like Tiger King. And in full disclosure, I should also tell you that my guilty pleasure during all of this, no shame, has been Pepperidge Farm Mint Milano cookies. My worst week was probably back in late March. I don't know about you guys, but I think that was the time when people reported they were having weird dreams and all that kind of stuff. But I'd eat a whole bag of those Mint Milanos and in one day. And I don't know what that is. I mean, maybe that's like 10,000 calories, but whatever. It was those were my darkest days. Since then, I've really tried to get back to some semblance of of a diet and slowly making progress. I can't see all your faces. I know you're there. I'm going to get started. Just talking about the economy, the stock market, when we might expect to get back to a world that resembles normalcy. The good news is, I think it'll happen a lot sooner than you think. At least that's my bet. There's a lot of people out there that have taken this pretty hard and harder than they should, because there are a lot of bright spots that have come out over the past few weeks. We didn't have a lot in the first few weeks, but we have had a lot of easing of the mind type news cycles over the last few weeks, and I think that you may have turned off the news at some point. You may have not gotten some of that. So, anyways, I'm gonna see if I can lift your spirits. We talked about questions, adding that to the messaging. Okay. So the first thing I want everyone to do is put this into perspective. I get a lot of questions from even clients. Is this going to be like the Great Depression? Is this going to be like 2008? I get a lot of those questions, and I think the first thing we have to do is make sure that we're comparing apples to apples, or at least trying to. Yes, we are in a recession, and I don't need dictionary definitions on a recession. A recession is just, a time when the economy is contracting. Economic statistics are contracting. There used to be this joke that what's the difference between a recession and a depression? And I get a lot of nerds who are like, oh, well, a recession is a 20% pullback from the high of the, and it's the joke makes it a little more simple. A recession is when your neighbor's out of work, and a depression is when you're out of work. So that's the joke, and it just means times are bad, and a depression sounds scarier than a recession because it means a lot more people typically. And so a recession, you don't need to define it or even accept the definition of a 20% contraction. Just know that it's a contraction, and times have slowed down, possibly gotten tough, but they've slowed down at the very least, and there's a reason for it. With the Great Depression, not only were we a totally different country and economy back then, it's really difficult to make those comparisons, but one of the biggest problems was that we had a run on liquidity. We had a run on the banks during the Great Depression. Okay, we were in the early stages of figuring out a modern economy, or I should say a more modern economy at the time. And that was one of the worst things, is that we had a liquidity issue, and that's something that you will not see today. The Federal Reserve has, you may have heard the mantra, don't fight the Fed. The Fed is basically saying, we're not going to allow, liquidity issues at the bank level. We're going to certainly, do our best to help liquidity issues in the general economy overall. And they're going to do good and bad with that, depending on who you're talking to. Obviously, for the people I feel the worst for, obviously, are the people that have retail jobs or service jobs. They were a waiter or a waitress, or like I said, a retail clerk of some sort, and they were already living paycheck to paycheck. They already had some debt that was mounting, and now they're in this situation. They didn't have a lot of liquidity before, and they certainly don't have much now. Unemployment's not going to make up for that, and these checks that a lot of people still haven't gotten certainly aren't going to make up for that either. So liquidity on an individual level is going to continue to be a problem, and it's going to be the biggest problem. That's I think it has been the biggest problem for any consumership, for any national consumership, and some of that's based on is on the individual. But in cases like this, we shut down the economy. We have volunteered, whether you like it or not, we've signed up to shut down this economy. So that is the most unique thing about this recession, is that we have actually volunteered to do it. It wasn't a run on the banks. It wasn't that we didn't have liquidity. It wasn't, a war. It was I guess you could say it is a war, but it wasn't a traditional war of sorts that we saw in the in the earlier part of the 20th century. This is truly something we signed up for because we encountered a virus that looked like it was going to be taking out massive chunks of uh, of hotspot cities across the nation, beginning with New York. Now, thank God that it hasn't we haven't seen New York's repeat themselves to that extent, and hopefully we never will. New York certainly is a unique city. My brother lives in Jersey City, right across the river, and he's been giving me full reports. But New York is unique for many, many reasons. But thank God we haven't seen that type of spark spread, and to Los Angeles. To be more direct, we have not seen that, anything like that. I hope we do. I hope we never will. But this is a man-made recession, if you want to look at it in a very sort of blunt way. We can come out of this anytime if we truly wanted to. Now, of course, some people are going to say, well, we don't want to, right? Because, a lot of people could potentially die. And, and of course, that's one of the things that people are talking about right now on the news. But you're listening to me instead of CNN, or Fox News or whoever you listen to. But that's okay. I guess what I'm trying to get at is that you need to know perspective-wise that this is something that can be recovered from quite quickly, if for any other reason that we control the gas pedal to some degree. We can decide whether to get going or hold back or pace it. And we're going to pace it. People that are saying, oh, we need to get back to business, or just open up the economy and society, full blown. I mean, I don't hear a lot of people saying that. I also don't hear a lot of people saying, oh, we need to quarantine until we have a vaccine, which may or may not come in the next couple of years. I don't hear a lot of people saying that. I think if you really, really listen, I think most of the country is saying, let's try to phase back in. Let's all discuss how to do it. There's going to be arguments on how to best do that. But I like to think that from a bird's eye view, we're kind of on the same page. Argue with that amongst yourselves if you wish. The other thing I want to talk to you about is modeling, because we talked about the trade-offs, about opening the economy versus keeping everyone quarantined. And one of the big things that everyone looks at, including the White House task force, are these models, right? These models that come from every part of the globe, but we have our preferred models. One thing you need to know about modeling, and I used to be a stock analyst, and one of the biggest parts of being a stock analyst is modeling. You're modeling out. Let's say I'm analyzing a company like Nike. How do I put together a model that's going to predict out what Nike's stock price might be 3 years from now? Well, look, I mean, I have a lot of information in that case. I have a lot of facts, information, historical data on what Nike's done in the past, in the past year or two, even the past week. I know what's going on. I have sales data. I've had conversations with the management, so I know, I have an idea of what they're rolling out, what products they're, working on, and I have a lot of information. I can put together a model that is fairly intelligent, but I got to tell you, there is no way I know what the Nike stock price is going to be in 3 years, no matter how awesome I think my model is. My model really isn't meant to predict, not with any great degree of certainty. Okay, that's just not what most models do, especially financial models. They don't really they're not trying to be the great predicting machine. And anybody who thinks that, you've been misled all this time. That's not what these models do. That's not what the modeling for the coronavirus and how many deaths or even cases we might have is meant to do. It's not meant to be some super accurate predicting machine. It's not. So you have to wipe that, from your thoughts to get to even sort of get to the next conversation, which is, okay, well, what is a model supposed to do? A model is a great sales tool. It definitely helps you get the conversation started. So if I'm preparing a model for my boss in some capacity of what sales are going to be like for the upcoming year, I'm going to use as much historical data, as much quality data as I have, but then there's going to be projections, right? And that's going to be the growth of the or negative growth of these of what we think the next year's upcoming year is going to be like. What factors into that, though? All sorts of variables, right? And it's the variables that make, the more variables and the more chaotic these variables are, or volatile these variables can be, even less the predicting accuracy of these models, if you even think that they're meant to really predict. So you have to accept the fact that these models are used to get the conversation started. They're meant to put a range out, okay? And that could be a huge range. And we've seen that with the coronavirus. Ranges from 60,000 to 2.2 million in terms of deaths that might happen. And then then they forget to tell you what the time range is for those deaths. Are we comparing this to a flu season? 5 months, or are we comparing this, or are we saying by Christmas we're going to have X number of deaths, or so they always seem to conveniently leave out the timelines. But the models are going to give us likely ranges that get the conversation started, that give us a benchmark, so we can now say, hey, this is what we were thinking of in terms of range. This is where we are now. This is where we think we can get to. As more data comes in, the models can become better and better at predicting, even though that's, again, not going to be their main job. So that's what you kind of have to get your arms around. I want you to take that same philosophy, or that same sort of opining that I've given you about modeling, and use that in the future when it comes to people, giving you models on what the real estate market's going to look like, or what the stock market's going to look like, or whatever. It really does. There are so many variables in all of these things. The Nike example I gave you, I might have gotten everything right about the Nike example if the economy had sort of repeated itself exactly, the way it had the last, 5 years, 3 years, whatever. Nike's going to do this. Okay, let's say I got it exactly right. Well, as far as all things, Nike. Well, the minute the economy changes, even though Nike's flying high and doing great, the minute we have a recession, and nobody escapes a recession, right? All of my modeling is for naught, because I didn't model a great recession in the next 3 years, right? In my model. If I did, I'm on a branch all alone. And I'm a hero, I guess, for one day. But that's the point, is that the bigger the variable, and there is no bigger variable than the economy and what's going to happen. You just can't predict in the short term. You do not have a let's say a high degree of confidence with your modeling or your predicting. Okay. So economic damage, we know that there's been a lot of economic damage caused to individuals and the overall economy. And we know that damage has definitely at least been short term. What we don't know is it more than short term? Is the damage going to, carry with us for the next, into the next year or throughout this next decade? I think that's crazy talk to even go there, because we just talked about, and you can't predict or model these things. And I certainly don't want to do it anecdotally. By the way, I'm drinking coconut water. One of my projects during all this downtime, as I went to a grocery store and I bought 15 different coconut waters, and some with pulp, some without pulp. And I'm having my own little taste testing fun at home. I'll tell you, if you really care, I'll tell you which one I ended up thinking was the best. So the economic damage that we know has been caused like I said, the individuals that I mentioned earlier that are in the retail service jobs, those are the ones those are the people that I feel the worst for. On the other hand, you could say that they already were damaged economically and financially, and they were. I mean, living paycheck to paycheck is really difficult, and so it's you already are damaged in a way, but you're fighting your way through it. You're at the very least you're recovering, or you're fighting, and you're struggling, but you're not totally out. Um, and the damage that's being caused now is it is taking some of those people, and it is really knocking them out. All that debt that was rotating and revolving, and the paycheck to paycheck, and people had to move back in with their parents, and people had to leave Los Angeles. I mean, all of these things. This is damage. Damage isn't quantified just by deaths or bankruptcies, but there are a lot of personal bankruptcies that will never get reported. And it's very stressful for everyone. Um, the good news is that my hair, geez, I mean, everyone needs a haircut, right? But gosh, so the good news is that I believe, as along with many experts, that this is going to be a quick recovery. Okay, quick-ish, however you want to, and I'll try to define that a little bit. Compared to other non-man-made recessions, okay, or non-volunteered for recessions. The analysts that you see on the media are talking about the difference between a V-shaped curve, a U-shaped curve, an L-shaped curve. A V-shaped curve, as you can imagine, is a quick fall and then a quick recovery. That's a V-shape, right? That's a good day, bad day kind of thing. A real quick. And a U-shaped recovery would be a little more drawn out, right? Not as sharp of a fall or recovery, which we know that can't even be true, right? This fall was so quick, we at least are half a V, and maybe the recovery will be slow. So you at the very least you have to call it a V/U, type diagram. The recovery might be U-shaped, but the fall was already was pretty steep. The L shape would be a really more long drawn out recession, like 2008, for example. I just want everyone to know that the experts do believe this will be a quicker recovery, and it makes sense. It should make sense. Where they're coming from. So there are some that aren't saying that, but I think the majority are. And you can ask yourself, do you think that we're going to have a pretty resilient population through all of this? Once we start to bounce back, and we're already opening up, right, in parts of the nation and definitely other countries. Do you think we're going to have a resilient consumership where we really start to get back to normal? Or are people going to have people learn behaviors over these last 2 months that they're not going to give up so easily? I don't think the latter is true. I think people are going to bounce back as fast as they can. We're going to get back to homeostasis as fast as possible, right? I think that is the natural. I think that is the way we're wired to be. And I just look at I haven't been able to work out much during this shutdown, and I just look at at my own physical fitness, and I go, geez, body sure does like to get back to its old self pretty quickly, doesn't it? Whether I like it or not, and I don't like it. But I think that's also analogous to us as consumers. I think we're going to try to get back out there pretty fast and be ourselves again, as much as we can be, right? I mean, they're going to, there's going to be the social distancing and all that, and I'm going to talk about that in a second. But I do think that 70% of the economy, 70 to 80% of the economy is the consumer, and it's going to be up to us to define whether that V-shaped curve actually happens, or V-shaped recovery actually happens. But I do believe that's where we're at. We don't have the structural damage, and I'll show you in these visuals in a bit. We don't have the structural damage that had been caused leading up to 2008, and that was caused, by the 2008 a Great Recession, the banking and housing crisis. Um, because of that, we had a really strong foundation going in. Nothing was wrong with us, okay? I mean, except for the obvious sort of ebbs and flows of different aspects of the economy. Corporate debt levels were getting a little higher than I was comfortable with, but nothing was quite out of hand, and nothing was super bubblicious at this point. We had a pretty solid foundation, and that's what's going to help us with the recovery as well. So a strong consumer, a strong foundation going in, and the fact that we like I said, we control how fast we get back to business. Those things give us a good degree of power and confidence motoring forward and coming out of this. Let's see. So just the follow-up question is, so when is the nation going to open back up as a whole? I mean, that's anyone's guess as far as when the last state will finally come in, and we'll probably be one of the last states that really opens everything up. Some states never even shut down, and you might be able to make a case for states that were totally isolated already from from everybody, that they didn't really have a huge need not to. But so it's going to happen. Major countries, Germany, I think, was one of the first ones to really start opening things up, and we're watching the successes that they're having, both there and in some of our states that are first to go back, try to go back to normal. And again, I'm not saying that that's the right thing to do in any particular way that a state might try it or a country might try it, but a phased-in approach seems to be the consensus opinion that everybody is willing to consider, as opposed to a full quarantine or a full opening up. What's it going to look like? We talked about the retail and service industries being the hardest hit. Those are the ones that are going to lag behind the most, obviously, right? I mean, no one's right away. You're not going to see a lot of people pouring into crowded areas. People are going to do that, but I'm saying you're not going to see that as the norm. I think that's going to be, you might see that on the news, and people gathering and really tightly in certain, maybe on a beach or for a show or whatever. So a lot of people are going to say, I'm going to do it anyways. I'm ready to get back to full normalcy, and that's what they're going to do. But I don't think that's going to be the norm for everyone else. I think you're going to see some hesitation, and that's going to show up on the consumer side, but it's going to show up more so in the fact that these businesses are going to have to, by governmental guidelines, city guidelines, they're going to have to keep their social distancing guidelines. So, and those will be, if we have success in terms of keeping numbers or keeping the curve flattened, the businesses will start to get be given more and more leeway by the government as time goes on. But yes, the retail and service industries will be the laggards. You can say that real estate obviously will be lagging as well, because just due to the higher priced retail ticket on what you sell. People probably aren't looking to make huge decisions like that right away. Not to say that people won't, but it won't be quite as easy out there. I will say this: if there's any bright spot for you guys, it's that your most powerful sales tool. It should have been probably for the last few years, anyways, but even more so in the next months to come, quarters to come, will be low interest rates. Insanely low, historically low interest rates, and that's going to be your best sales tool. I mean, how can it not be? And assuming that fundamental unemployment doesn't take a huge enduring hit, that will be a big boost for you guys without the offsetting whammy. But let me define that real quickly. When I say that, when I say enduring fundamental employment, I'm talking about jobs that are never going to come back, and where they won't rehire, where they just decided to move on from 100 employees, and they're going to move forward with 75 for for the foreseeable future. That kind of thing, and then it lasts for, like I said, indefinitely. I don't think that's the type of unemployment we're going to see in large part. I think that you are going to see. I'll give you an example. My sister works at the Kennedy Center in Washington, D.C. It's gotten a lot of press because it was tied up in the stimulus packages, but they're going at some point. They're going to get back to, full capacity, but it's going to be a while for the Kennedy Center to get back to full capacity, where they're, doing a bunch of shows and they're filling those seats. So that, but they're going to get there. They're going to get there at some point, right? So I want to say that that's not going to be fundamentally affected longer term. It is going to be in the short and intermediate term. There's no doubt. And that's an extreme example because that definitely involves a lot of people in crowded, isolated in one room and all that. But it's going to get there. Now, these restaurants, some of them are going to go out of business, right? And I mean, they were already on the edge, let's say some of them, and they're never coming back. Well, what else? A new restaurant comes in and opens up, and they have to hire employees. So I think individual businesses will have fundamental unemployment issues, but I think that will be replaced by new businesses. Maybe not the same type. Maybe in certain industries won't recover quite as well. But in that case, again, I think you'll have individual fundamental employment issues, but not industry wide that last for a long, long time. So if somebody can make the case that we're going to have fundamental, jobs that will not come back, that just simply won't come back, and in a large part across the economy, I'd certainly like to hear more about it, of that perspective. But I think we're going to get back to normalcy, something resembling normal, faster than you think, and I believe that the unemployment talk, which some are saying it could be between 15 and 25% right now. I believe that will be quickly, not return to 3% levels that we had right away, but I think we'll quickly see that start to fall grossly down to levels that make a lot more sense. And I think that'll be a wake-up call to people that our economy is more resilient than you think, and the consumer is more resilient than you think. All right, so I'm going to share some graphs with you guys, if I can remember the technology, and you guys can take some of this in and Q&A if you didn't understand something. One thing I'm going to give you a chance to do here too, if you have any questions, is I'm going to share my contact info real quick. If you want to shoot me a message, I'll see if I can get back to you guys. There's not that many of you, so but I'm going to share some graphs on things you might be able to use for your clients and for yourselves to provide some solace and just something that makes you sound smart too. When it comes to what you're looking at, as far as a return to the economy as we'd like it to be. So give me 1 second. Let's go to here. Okay, so this is just my contact info. If you want to drop me an email.
Hey Greg, it's not showing your contact info right now. It's showing your the folder.
Showing the folder. Okay, so hold on 1 second. Let me do the thing that we talked about that we wouldn't do. stop the share. Okay, let me share screen, and then this time I'll just do screen. Does that work?
Now we see your contact info. Thanks.
Okay. So this is just my email. If you want to shoot me an email, this is my phone number. If you want to text me or call me, and there's my website. If you wanted to just go there and just to read more about me. But write that stuff down. I'll show it one more time near the end. Okay, so let's go into. I think I can get rid of this. To slide. Okay. Okay, so our first slide, guys, can you see what I'm doing here? This is what they called the Great Recession, right? 2008 to 2009. It really did kind of reach over the years. This is the blue line is the S&P 500, the American economy. Let's call it the stock market for our purposes. And let's say it starts out at 10,000 because you need a nice flat number, right? You need it to start at. The red line is real estate. It's a real estate mutual, a REIT fund, real estate investment trust fund that type fund that that will sort of speak more to your business. But I'll show you here that this fall from 2008 to 2009, we fell from 10,000 all the way down here to less than 5,000. So in other words, the stock market was cut in half, and it took sort of October 2008 when it really started to fall down to April 2009. So it was a drawn out 6 months. This is starting here in May of 2008, and this is about the bottom here about March, mid-March of 2009. Okay, now real estate fell even worse, right? Now we're having that same issue now, even though this isn't a quote unquote called housing bubble or housing crisis. Again, it's the nature of what happens to real estate in correlation to the stock market, which appears to be sort of the modern day correlation after what we saw in 2008 as well. And now look how long it took to recover. We didn't recover till about 2011 for this blue line to get back to where it started from, right? Really even longer, but I'm really looking at here though, where it all kind of started. So the red line, it lagged, but eventually it actually really bounced back, right? And it even started to surpass the stock market beginning in late 2010. So that's something you can sort of just historically you can remember what happened last time we had any type of recession, even though this recession is very different. Okay, now this slide is the COVID-19 2020 slide, and this is the real estate line here that again fell more than the stock market and continues to kind of exist in that sub level. So if the stock market is only down about 15%, can you believe that the stock market is only down 15% from its high? At one point we were down 35%. The real estate is actually down, or this particular REIT is down 25%. So it's 10% below the market. And at its worst, this fund fell almost 50%, not quite. When this whole thing first started, these looked really, really bad. Stock market. So that's kind of what we saw in the graph above, except for this is a much longer time period, but same behavior out of the gate. So at some point when we recover, you would expect real estate to eventually surge as we get back to an economy we can all. This is the unemployment rate from 2008 to 2015. And as you can see, going into the housing crisis, right, the big Great Recession, we had about 5% unemployment that peaked out around 10, in 2009, and then slowly, it took a while for us to even get back to 5%. It took about 6 years for us to get back, and then all of a sudden now we're down, at 3% levels, right, until COVID-19. I do not see this being, and this is why I talked about fundamental unemployment for a while there. I do not see this being something we repeat in terms of our recovery. I believe that it's going to be much starker type recovery curve, and for all the reasons we discussed. So, but I just want you to know that that's kind of where things worked in 2008 when we had a real fundamental recession. This is consumer sentiment. This is important because this is how we judge how we the consumer, how we're rebounding from this, and how we're thinking and behaving. Consumer sentiment was close to 100 where the index started in the 80s, right before the Great Recession of 2008, and it fell all the way down close to 50. Which means people were feeling pretty bad about things here in 2008, 2009. We made a nice recovery on sentiment with a few blips all the way up until recently, and consumer sentiment has started to dip again, as you can see here. And these numbers come in at a lag, so I can't give you the graph. I can give you the number. So we said that it almost touched 50 in the Great Recession. It started at 100. It was at about 100. Well, recently we have fallen to, with this graph, you can see from 100 in March we fell to March we fell to 89. Yeah, sorry. In March we fell to 89, coming off of February of 100, and then now we're down to 71.8 at the end of April. So we'll see where the May numbers come in, but that shows you where sentiment is. We are not down as low as we got to in 2008. That's a good thing. But we will be watching this to see, again, how the consumer's mindset is, shaping up. This is the S&P 500, the stock market since 1996, and this is me being optimistic and trying to be an optimist and trying to give you guys some positive things to think about. This is if you have been a stock investor all this time, okay, since 1996, made a lot of money in the 90s. Yeah, we had a lost decade from 2000 to 2010. It was the lost decade because we had the tech bubble, and then we had the housing bubble. We had two major recessions in a decade, and we pretty much went nowhere, right? Well, that's okay because we're long-term investors, right? We're long-term investors. If we were patient, we enjoyed the 90s. We sat out essentially a decade, and then we just took off, just absolutely took off from 2010. Now, like I said, the stock market's only 15% off its high before COVID-19. So if you're an investor, you're feeling pretty good right now. I mean, overall, you're saying, hey, my 401k, my IRAs, man, they're doing all right, and they are. People want to know what the disconnect is between the stock market and the economy. Well, I want to tell you that the stock market is doing well because it believes, I think what we've been talking about on this call is it believes that we will recover quickly. And the smart money is saying we believe the economy will recover quickly. And we don't need to get into the nitty gritty of modeling and estimates to say that. We just believe that is going to be very true. And they believe that the stock market believes that, yeah, there's been damage done, but that we're going to have a nice recovery coming out of it. So that's what I think the stock market is telling us. If the stock market receives new information, if we receive new information as investors, that might change. But this is where we stand. So that's just some visuals behind on what things we're looking at. We're looking at consumer sentiment. We're looking at levels in terms of what we think the economy will do moving forward, how much damage is being done, and the strength of our consumership moving forward. So let me just quickly tell you that what I've been doing with my clients through all of this. We've been using this as an opportunity to get the portfolio ready for the recovery, to get the portfolio balanced to a point where we think we look good moving forward. When the market fell 35%, but even before that, when the market was down about 20%, I was already looking to take advantage of the stock market correction for my clients, little by little. I didn't do it all at once, but taking money out of bonds, taking money out of annuities, and getting that money ready to buy at certain levels as the stock market continued to dip to unprecedented levels and what I believe to be irrational levels. Turns out that the stock market agreed with me that we were being irrational, and instead of being down 35% today, we're only down 15%. So made a lot of good moves, and I know a lot of people. I wasn't the only one to do that. I know a lot of people, we're doing this as well, and including Warren Buffett and Mark Cuban, who, were talking about how they would buy on down days and look for value. But there was a lot of arbitrage when the market was down 35%, especially, and individual stocks versus ETFs versus mutual funds. And a keen eye could see some of the craziness that was happening. And that's, believe it or not, that's actually when my value is probably at its highest to my clients, when I'm staying calm during those times and looking for opportunities instead of saying, oh gosh, run for the hills, everybody, and let's move everything into cash. I'm not saying the stock market will continue to recover at this pace. It won't. I think it already has kind of started to settle in a little bit, but it's recovered quite nicely. And unless we get some really bad news, I don't think we'll revisit those, negative 35% levels. Unless we just things start to happen that we couldn't have imagined. Then we likely won't revisit those levels. That said, be careful. If you get a bunch of money tomorrow, if you inherit a bunch of money tomorrow, don't just throw it all in the stock market. Definitely have a phased-in approach, just like you have. We're going to have a phased-in approach with getting back to normal with the coronavirus. One of the biggest things you can do with all this downtime, in my opinion, is check in with your investments. So when you're done with the Tiger King, check in with your investments. How do you do that? Well, you might not know how to do that, and most people don't. So you need to talk to somebody who does. And when I say check in, I mean everything. I'm talking about your brokerage accounts, your 401ks, your IRAs, everything. And if you have at least $50,000 to $100,000 that you've saved up, and or some of hopefully a lot of that you're saving towards retirement, you really need to be working with a financial advisor. Those of you who are still on the call, I will give all of you who qualify, meaning you have at least that type of money to even work with an advisor. I'll give you all a free consultation to help you look at your portfolios. We'll talk on the phone, and we'll maybe you can send me your statements. We'll look at what you're doing, see if there's any opportunities, and I'll tell you what you're not doing great, what you haven't been doing great, but I'll also tell you how to fix it. I would take advantage of this, guys, if with all the downtime and the fact that you probably have been neglecting, your accounts for a long time. Most people don't do a great job managing their money. They do a good job saving, but then they don't do a good job investing it. I work for myself. I'm not tied to any big bank or brokerage, so I'll give you an independent, unbiased opinion of what you're doing. And I would say just treat your wealth like your health. Make sure you get at least a first opinion. If you already have a financial advisor, I'll give you a second opinion. I'll give you a second set of eyes, and I'll tell you what I think you're doing right or wrong. So I would take advantage of that. I'll give you my contact information one more time. Nikki's going to tap into some Q&A. Let me just share this with you one more time so you can write down. There you go. And Nikki, how are you doing with that Q&A? Do we have any good questions, if any?
Right now, the only one I have is just people want to know how they could get a hold of the graphs that you shared.
Oh, okay. Yeah. So That's actually not a bad idea. So let me take this down here. So these graphs are all publicly available, guys. They really are. Some of them are harder to get to. Let me start with the easy ones. This is easy. This is right. Just basically just type in Fred. If you just type in Fred in Google, you'll come up with all the national economic data for all sorts of different things, not just unemployment, not just consumer sentiment. They have all sorts of things. Inflation. You can even type in different types of unemployment rates that you're looking for. So you can find this online easily, not a problem. This one I'm not sure where I got. This one I think I got from tradingeconomics.com, but it really came from University of Michigan, which does the consumer confidence numbers. You can either go to tradingeconomics.com if you really want that graph, or you can go to the University of Michigan Consumer Confidence Board webpage. These graphs that I have here, I created this one, and I created these two up here. These are all graphs that I got from Morningstar.com, which is a great tool for how I analyze investments and historical data. The great thing about Morningstar is that this blue line that I showed you, this it doesn't just show you the price graph. This includes all the dividends and everything that's paid, so it's and reinvested. So this is the blue line represents an all-in total return, which is what you want to look at. You never want to look at just a price return, right? I mean, if you're looking at a stock that doesn't pay a dividend, then it's the same thing. But a lot of mutual funds and obviously REITs, they pay especially with those kinds of things and bonds, and you need to go to Morningstar. You can't just go to Yahoo Finance. Okay, don't let anybody ever trick you with that stuff. I see a lot of people showing bad graphs out there, and it's really sad. But now now you're smarter than that. So that's where I got the graphs. That's where you can follow the numbers. It's also published, in news articles on a daily basis.
We got another question.
Okay.
If we have a relapse of the coronavirus, what effect do you think this will have on the stock market? What is happening in the global market, mainly China, Spain, and Italy, since they are ahead of us on the coronavirus? Should I be watching those stock markets as well?
Well, as far as okay, so let me take that in two parts. Okay, so the second question deals with the global approach and the global recovery. The first question deals with the relapse. So we are going to have another, surge. I mean, I say this with, some degree of certainty. Don't. If it doesn't happen, don't shoot me. We're most likely going to have another surge in coronavirus cases and deaths in parts of the country. Probably not all at once, but and we're going to have some new hot spots. And again, I don't think anything like the level of New York, but and that's going to happen. That's part of reopening. People expect that when you reopen. The question is, will we break through the range of possible outcomes for that surge? Will it be something that we way out of our ranges, way out of our modeling, that they never even assumed that? Will the hospitals be overrun with the new surge? Assuming that it's the surges that happen when we reopen, assuming that they are within reason of what we modeled, what we expected, as far as likely outcome, and assuming that the hospital systems are not direly overrun, I think that the market will be volatile, but I don't think it'll be like up 10%, down 10% days like we had in early March. I think it'll be much more limited in volatility. But yeah, so it's really dependent on how that happens. Now, the best thing would be we don't have any new hotspots, but let's say that Germany is very successful. Going to your global question, let's say Germany is very successful and they're having a really good go of it as they return to normalcy. and let's say Sweden, turns out what Sweden's approach, which wasn't just purely herd immunity, but they had sort of a more autocratic social distancing. Let's say that turns out in hindsight to look okay. Then that'll be really good news. Now that could be offset by other countries, right? So let's say France has suddenly has a real bad problem, or the UK, and then we'll have mixed information again. Okay, and then we'll have that'll be but assuming that all bad news doesn't happen at once and happen across the board. I have a feeling we're gonna have a mixed bag of things. Let's hope it's more positive. We had that at the beginning. We had good news out of South Korea and Japan, and we had really bad news out of Italy and Spain. But let's hope that we have more and more of the good news as we slowly get the other part of that is that we're opening up slowly, right, state by state. There are chunks of states that are opening, but there are a lot who are not opening fully or halfway even. So there will be some time to get some more data before a full national outlay happens. I guess just the last piece on that would be the stock market. Don't focus too much on the stock market. In terms of don't worry so much about pullbacks and retreading old grounds, because I'm sure we will have some pretty rough period of days strung together, and but ultimately, remember, the reason the market was down 35%, and I can't believe it, in some ways you have to be glad it never got to 50%, was because we were really scared there for a while. We were, people were really getting apocalyptic about this. This is the next big one. This was the Spanish flu. And so you have to say that that 35% was representative of a true madness of the crowd, everybody having the worst thoughts. And I think that, we probably won't touch that again unless we have reason to become apocalyptic again. Hopefully we don't.
Okay. How do you think the number of foreclosures caused by this pandemic compares with the number of foreclosures as a result of the financial crisis of 2008?
I haven't done that analysis. I'm sure somebody has. But I think it's too early to even do that analysis because remember in 2008 that there was a true long-term hit, jobs that would never come back, industries that would never come back. And the recovery itself was so long and drawn out, right? So it's going to be very different, number one, just because of those things, but also because I truly don't believe that industries will, in most part, will disappear or just be gone. Things will change, but and I also don't like it when people are saying, oh gosh, will we ever get back to normal? Guys, we're going to be back to normal at some point. It's just a matter of getting there. I mean, the world has not, it's not going to change like this overnight. You just have to keep, let's be reasonable here. So I would just tell you that because I don't believe that jobs are going to be lost forever like they were in 2008, in large scale, I don't think you're going to see that long term. I mean, the foreclosure numbers get anywhere near like they were 2008. You just have to. That should make sense to you. The recovery won't be 3 years like 2008. At least nobody's suggesting that. So I don't think you have to. I don't know if that comparison should even be considered right now. It's a good question, but I don't think it's. I don't think you're going to be comparing apples to apples because these are not like recoveries. These are not like crashes.
Sorry, Greg. Do you think that rentals will become more in demand, and how do you think the housing shortage will be affected? Do you think there'll be a sharp drop in the demand for commercial retail and office space after companies realize how well many of them can work from home now?
Well, I don't think there's going to be a lot of epiphany type enlightenment, from the top. from the top executives on a lot of this stuff. I don't think they're going to be like, well, let's just get rid of our commercial, workspace and make everybody work from home. I mean, I think some people may do it out of necessity. They may have to do it out of necessity because their businesses took a real hit and they already had some debt and they already were, struggling as a business. I don't think they'll do it because they think it's a better way of doing business per se. So I think you'll see that for sure. You'll see it happen in trenches, but for someone to say, maybe, hey, they talk to their bosses and they say, hey, we really enjoyed working from home. Can we work, 1 day a week from home moving forward, just because we liked it. We enjoyed it. We got to spend time with our kids, or, it's just nice not being in the office. You could see that. I think we were already trending towards that, as a work society. But no, I don't think you're going to see a massive drop in commercial space except out of necessity. And again, this is my bet, but I don't think that's where we're heading as far as rents and the like. The good news is that nobody's getting kicked out of their house. Nobody's getting kicked out of their apartment right now. A lot of landlords are offering discounts. Most landlords are working with their people to pay reduced rent or defer some of that rent. I got an offer. I rent. I got a letter from my landlord just this past month that they were offering. I didn't even ask for it. They were offering 5% off on everybody's rent. I mean, it's only 5%, I know, but I didn't even ask for it. I didn't need it, so I didn't ask for it. But that people are doing things to try and help, and I think a lot of people are going to go into their landlords and say, hey, look, I don't want to keep deferring my rent. How about I pay 25% less, and that's something I can handle because I've lost 25% of my income. And so I think you're going to see a lot of that. But yes, there's going to be a great time to move. If you're an apartment renter and you haven't lost your income or much of it, you might find some great deals to move to a new apartment that was a place that cost $4,000 a month is now $2,600 a month. But that's going to correct pretty quickly. Okay. That might happen for a 1-year lease, but that's going to correct pretty quickly when the economy recovers. I mean, we do live in LA for God's sakes, everybody wants to be here. So, right or wrong, for the sunshine. So you're going to see that. But you're going to have some short-term pain. Absolutely. Landlords are going to hurt. Renters are going to hurt. Housing prices are going to, take a little bit of a stumble, but I just don't think you guys can't get through it. It's not going to be, it's not looking like 2008 at all.
Do you think it's a good time for real estate investments?
Well, it depends on how you're approaching it, right? And it depends on what's happening with that particular property you're looking at. I mean, if the property you're looking at, was really insulated and during all of this, and has maintained its value for whatever reason, obviously that it's probably not as good a time as it was 2-3 months ago. But if you have a place, just the same way I'm looking at stocks and mutual funds, if you're looking at property or areas that have got with arbitrage where they've gotten unnecessarily hit, and it doesn't make any sense to you, it's not matching up to other neighborhoods and things like that, then you might be able to find some arbitrage as far as properties and things like that. But it's only a good time to invest ever in anything if the price looks good to you and you plan on holding it for a long time. I mean, that's how you have to look at things, right? I can't tell you that buying stocks today is a good idea if you plan on selling next week. But if you tell me that you're not planning on selling for 10 years, I feel pretty good in telling you that it's a good move. If you buy a nice diversified, group of stocks or a really solid company. But and it's the same thing with real estate. So for you guys, if you're looking to invest and you see some good arbitrage, well, Warren Buffett loves to buy things when they've been unnecessarily devalued. So the answer, you already know, is yes. But you've got to do the homework on whether it has been devalued. And I know a lot of places aren't selling right now, so you might not have a lot of you might not have a lot of comps to figure that out, but however you go about figuring it out, you've got to do your research on that stuff.
Great. I think that's all our questions today. We appreciate your time.
Yeah. Thanks, Nikki. Maybe we'll do another one of these. Hopefully we don't have to. Hopefully I can do this in person next time, but
Yes.
maybe we'll do another one of these in the next couple of weeks or something with
yes,
a
definitely.
different subject.
Yes, definitely. Thank you so much. And thank you all for being on, and we'll see you on the next class. Thanks, Greg.
Bye, guys.
Bye-bye.